Welcome to AIADA's AutoTalk. I am Dan Barson, your host for today's program. AutoTalks are held the third Tuesday of each month. Our December program included 2016 predictions and market projections by some of the panelists that we have on today's call. Today, our panel is going to go back and revisit some of those projections. Our panel today includes, and a new member, we're proud to have him on board today, Mark Fricolo, Senior VP, Lender Solutions of DealerTrack. David Lim is back, Vice President, Equity Analyst, Wells Fargo Security Services. And also back joining us today is Tom Contos, Senior VP, Chief Economist, ADESA Analytical Services. Gentlemen, welcome, and let's dive right in. I know in December we had looked at full year projections on sales, and I guess I just want to get everybody's opinion on what they're looking at for the end of the year here. Mark, I'll start with you.
So since I'm the new guy, I don't have to come off my prediction that I gave in December. This would be my first prediction, but I think that due to the soft sales in May, which certainly gave me pause, I think there is enough momentum to take us through the rest of this year and make this year another really strong year. So I remain bullish for the rest of the year, and I would put the SAR between 17.1 and 17.2. Dan.
Great. David, I know we kicked this around in December for quite a while. Are you backing off your number?
Yeah. So I mean, I think that all the indications through year to date is pointing to more of a low 17 million number, and we've done various analytical exercises looking at historical data, and it sort of points that way. Initially, we thought the year would have been around 17.5, a little better than what we did in 15. But given some of the recent data points related to retail and fleet mix, we think that the 17 million number can be exceeded, but we're not as optimistic as we were back in December.
And Tom, I remember you were taking a more conservative approach in December. What's your opinion?
Yeah, I think I'm kind of holding to what I thought back then, which was high 16s, like 16.9 to 17.3 or 4, somewhere in there. Yeah. I was kind of in the low 17s, high 16s, and I was basing that on just cumulatively several years in a row of strong vehicle sales, and at some point kind of a waning of the pent-up demand that people took their time after the recession to replace their vehicles, perhaps, and as they did that, and as they've done that cumulatively, I think that's caused me to be a little more uncertain about how this year will go. On top of that, we got the election, which creates uncertainty on big ticket purchases anyway. So those were the factors I was thinking back then, and it seems to be kind of bearing out, although fleet sales, as David just mentioned, and incentives are a couple of levers that manufacturers can continue to pull to keep sales at least even with last year. And so far, if you look at the year-to-date sales as opposed to SAR, year-to-date sales are actually a little bit higher than last year, year-to-date through May, by about 80,000 units. So far it's been pretty flat. We'll see if that holds through year-end. I think not.
Yes. And guys, again, we looked at some of the factors driving the market, and I know, Tom, you just mentioned a few, but those included interest rates, fuel prices, consumer confidence, and Tom, you had mentioned the election, the age of units in an operation, which, is near and dear to a lot of folks' heart, bank purchasing policy, Mark. Again, you're close to that one. Have we seen any changes in any of these items, or do you guys see any clouds on the horizon as it relates to any of those? And David, I'll start with you on this one.
Yeah, I mean, what I would say that there's always a situation with potential interest rate hikes and fuel prices to rise. I know the fuel prices have been coming off as of late, and it's been sort of bumping along the bottom, if you will. But in both cases, rising rates, rising fuel would be headwinds to consumers' purchasability in our view. And I think with higher rates, it's going to be difficult for consumers to, let's say, move up from a mix standpoint, as well as dealers trying to push additional F&I products to the consumer. But you know, as we stand right now, I think the market is pretty good for buying vehicles, whether it be new or used. And if the Fed were to raise rates, it's sort of an indication that I would like to believe it's an indication that the economy is getting better, and they have to raise rates because of that reason.
Right. Mark, do you have any comments or any of these items of concern?
Sure, Dan. So I think that you know, the interest rates have remained fairly static, you know, a small increase. But the big factor that's changed in my mind is around you know, a tightening in credit for the subprime borrowers. So this was signaled several weeks ago publicly by Jamie Dimon and quickly followed up by some of the other large banks with commentary on subprime lending. And so I think that the larger banks will be tightening up on subprime lending. Now, whether that will affect you know, whether a subprime borrower can get credit, I don't think that will in the 2016 timeframe. I think there's plenty of credit out there, and there's plenty of lenders specializing in the subprime segment. But it is a factor that is changing.
Right, right. Tom, do you want to comment on this? Any of these items? I know you touched upon one or two of these earlier, but anything stick out to you?
Yeah, I guess I mentioned the pent-up demand, which I think that'd be reflected in your point about age of units in operation, where people might have held on to their car longer, and you did see that in some of the average age data going up of the and as we see new car sales kind of replenish those aged units, I think that age will kind of start tapering and maybe even coming back down again. But in the meantime, I think a lot of the folks that did delay those purchases have gone ahead and done so. If you look at new and used vehicle sales, there's been a lot of replacement demand that's been satisfied at this point. Not that there won't be reasons to buy cars going forward. We're already seeing another, you know, close to last year's results thus far this year. So people are still buying cars. I don't want to over dramatize it, but you know, a lot of the pent-up demand is spent up at this point. So that would be the factor that I would look at going into the rest of the year.
Right, right. Guys, another point we really kind of focused in on in December was the banks and the captives, and they had stepped up and were buying a bit more aggressively. Are we continuing to see that? And to your point, are we seeing, Mark, I think you mentioned this, are we seeing any delinquency or default rates an uptick? And Mark, I'll go ahead and start with you on this one.
Okay. Thanks, Dan. So the market is, you know, still very competitive, and deals are certainly getting done. But some of the information that I've been seeing recently is showing that delinquency rates are rising, particularly on subprime loans. And what surprised me was, you know, the delinquencies that are being logged fairly a short time frame after the loan origination. So, you know, that was surprising to me. They're not alarming at this point, but the trend has clearly been upward over the last 6 years, and year over year for Q1 2016, delinquencies increased to 1.12% of the portfolio versus 99% at the end of Q1 2015. And a delinquency would be defined as, how I'm defining it, is more than 60 days past due. And I think we're also seeing, just in consumer credit, delinquencies ticking up as you read the Wall Street Journal. I think it was just in the last few days, Synchrony increased its credit card losses by about 20 to 30 bips for the next 12 months.
Right. David, any observations there from what?
Yeah. I mean, I would say that it seems like some level of aggressiveness, or at least what we're hearing is it's really from like the PE-backed lenders that have become more aggressive, and the ABS market is definitely pricing for that. Delinquencies have gone up. Those are some of the numbers that we've seen for the industry in general. But remember, the historical vintage has also been good. I would say that anecdotally, what we've heard through a number of dealers are people coming back, as in vehicles getting repossessed, but that same person coming back and being approved for another loan. So, those are like one-off instances, but having an example like that, I found it to be interesting. It sort of signifies, the time that we're living in here with, pretty good credit availability. But I would say that a lot of maybe the entrenched players, people or banks that have a long history of lending, have really phenomenal models to really predict default rates as long as the data that's being entered is correct and accurate. So I think this is sort of a different beast. I know that there's a lot of discussion of saying, oh, is there a automotive credit bubble? I mean, but unlike the housing sector, I think everybody knows that vehicles depreciate. They don't appreciate in value, and I think that's a key difference.
Right. Hey, Tom, are you hearing anything from your larger commercial accounts around this?
Nothing as of yet, although the delinquency rate information that Mark mentioned is something I'm kind of keeping a keen eye on as well. To me, the likelihood of more repossessions is driven more by more cars, more outstanding paper, loans and leases. So I'm putting more emphasis in my guidance on credit quantity, not credit quality. Because though credit quality may be slipping a tad, it's still relatively low compared to post-recession and during the recession. So again, it bears monitoring, but just the sheer amount of cars and that are represented at risk out there in terms of the paper that's outstanding tells me that at the auctions we're going to see more repos. And indeed, that's kind of what we're hearing from the prime, subprime banks, captives, and also the automotive finance companies. So yeah. I do think we'll see more repos.
Hey guys, one area of keen interest on our last program in December was leasing, and boy, that seems to be a hot issue. We've seen it continue to increase in popularity. Do we anticipate that trend to continue? And I'd like to even follow that question up. Are we going to see leasing programs on used units? Do we see that growing? And David, I'll toss that to you first.
Yeah, I would say that leasing will likely continue to trend higher, and I think there's a couple of reasons for that. One, residual values are really, really favorable, and having residual values so high, it really comes into a good play, if you will, for the dealers as well as the OEMs to work down the monthly payments for a prospective buyer or prospective new car customer. And two, OEMs, as you know, always have a number that they got to reach or that they're looking for, and it's just a tool for any OEM out there to really try to seal the deal, if you will. I would say going forward, it could be difficult to say in how high lease rates could go, as in the lease take rates. But residuals can only go so high, and with the discussion of off-lease vehicles coming back, I mean, could that place some pressure on residual values? I mean, we think it could, and in that scenario, it becomes a little bit more difficult to do the monthly payment strategy that some of these OEMs have resorted to. On leasing of used vehicles, yeah, we see that could take place. The question is, how prevalent can that be? And obviously, from a dealer standpoint, and I know that we have many dealers here, I mean, the big factor is obviously residual values for 48 and 60 months out, and that's something that the OEMs have to take into consideration when doing CPO leases.
Right. Mark, are you guys at DealerTrack seeing a lot more leasing activity through your services and portals?
Yeah, clearly leasing is up for the year. It's I think above 31%, just above 31% currently for new cars. And I'm not sure how much more room it has to go up in the new car area. But we're also, Ally has come out with a leasing program, and there's certainly some Highline dealers doing some leasing too on used cars. So Allies is on used cars, so that's something new. Right.
Tom, that's going to have a big impact through the lanes here in a few years, don't you think? And what's your take and outlook?
Yeah, absolutely. And we're already seeing that. I'd say even in the last couple of years, when you look at auction volumes and just look at the NAAA survey data, they do an annual survey and estimate the total number that went through auctions, physical auctions, and those numbers have gone up at a clip of around 6 or 7%. And I expect that kind of a rate to go into 16 and 17 as well. So when you have that kind of uptick in supply, you're going to have downward pressure on residual values. Thus far, the market's been absorbing that volume very well for a couple of reasons. Number one, dealers needed the cars. Certified pre-owned sales kind of lend themselves to absorbing off-lease volume, so that's been a good thing for the growth in supply. On top of that, the multiple channels that captives primarily and others in the leasing space, the banks, employ the various channels to get cars sold. So there's not necessarily a concentration of volume just at the physical auctions. The upstream sales that we handle a lot of at ADESA, those upstream sales kind of dilute the impact of supply to some degree and allow the cars to kind of ease into the market. Some are being bought upstream by the originating dealer. Others are selling in closed sales to franchisees of the same brand. And then there's an open iteration upstream as well where a lot of the cars go. So even before they go to auction, we've skimmed some of the cream, so to speak. And that again helps dilute the impact of growing supply. Going forward, that's going to get tougher and tougher. We're already seeing a little bit more attrition, as we call it, more of the cars not being purchased upstream and working their way downstream, and that's going to put further pressure on prices going forward. That's what we're already starting to see. Yeah.
And Tom, I'm going to follow that up with you about used vehicle sales this year. Do we expect a record year? And guys, on CPO units, do we expect a record CPO year this year? And Tom, I'll let you go ahead and start with that one.
Yeah, I'd say yes to both. And in fact, last year was a record year for both total used vehicle sales and CPO sales. CPO sales are getting to be about 20% of franchise dealers' used vehicle sales, and that's up from 17% last year. So year-to-date through May, that's at about 20+%. So the CPO unit is really an increasingly attractive unit for franchise dealers to promote and sell, and for consumers to, get into the used car market. Many times it's not cannibalizing necessarily from new car sales. It's getting somebody in to buy, say, a certified pre-owned luxury vehicle brand that they might not otherwise be able to afford a new vehicle, but hopefully down the road they're able to get a new car in the same brand. So I think they're working in a very complementary fashion. Used vehicle sales so far through May by franchise dealers are up 3.1%, and for independent dealers, who are very important at the auctions, they're buying a lot of the repos and a lot of the older units. Their sales are up 6.1%. So if you think about it, it's almost like supply is creating its own demand. The supply of volume that's coming back, both from off-lease cars, repos, off-rentals, commercial fleet, and dealer trades, all of those vehicles are creating supply that gets bought at retail, and it's just prices that have to adjust to get that done.
Right, right. Mark, what are you guys seeing through Dealer Track?
So we're seeing very healthy increases in used car activity year to date. And I agree with Tom. I think that both for the CPOs and for used cars, this will be another record year above last year. And additionally, I think that there's more channels to sell the cars through. So channels such as Carvana and Q Auto over at Asbury open up new avenues, new channels for the distribution of used cars. So as all these cars are coming off lease over the next few years, we do have a broader distribution channel or more channels than we've had in the past. So that may help, or it should help, residual values over the long term.
Right, right. Tom, let me ask you this. With all of this, we had heard big lease cycle coming through, right? And basically a big wave of lease returns coming up through the system. What's the impact going to be on the wholesale prices? And are you seeing any residual values under pressure at this point? What are you guys seeing there at ADESA?
Yeah, for sure we're seeing softening of wholesale values, but from very strong values that we've had for several years now while there was a supply shortage. So now that everything's reversing and we're getting a supply surplus, Economics 101 will tell you, unless demand can improve markedly, which I'd say we've already covered very well, that demand is strong, and has helped, minimize the impact of supply to used vehicle values. Nevertheless, cumulatively now, as we're a couple of years of receiving more off-lease volume, and we will continue to receive it really for the next 3 years, looking at new car sales this year and leasing this year tells us that in 18 and 19, we should be seeing more off-lease volume as well. So anyway, with all that kind of pressure from supply cumulatively, there's only so much demand can do without an adjustment in price. So my expectation, I'm on record as saying, 5 to 7% growth in supply is going to generate probably 3 to 5% downward pressure on overall wholesale values if you hold constant for the ages of cars and things like that. It's always a little hard to get that to work out in terms of the actual numbers of that turn up in our indexes and price averages that we provide, because the mix of the cars can change so much and the ages of the cars are changing. But holding constant for those factors, I'm fairly certain we'll see decline in values in that kind of a neighborhood.
Right. And are we seeing a big volume increase through the lanes, Tom, the first half? And do we expect that to continue for the second half?
Yeah, so far that's about the rate we've been seeing so far this year. Looking at auction data, volumes are up about 6–7% again. Yeah, year to date compared to year to date last year.
Right, right. Guys, fuel prices are still extremely low when adjusted for inflation. I know they did uptick a little bit, but prices at the pump are still cheap. What's the impact on sales and basically the mix of vehicles? There's been a lot of chatter and a lot of articles out there about how sedans are just so slow off the lots, what's going to be the impact for the long term? Do we see any long-term trends around this? And David, I'll let you go first on this.
Yeah, I mean, fuel prices have definitely been a awesome tailwind to the shift to the light truck market, mainly like CUVs, smaller cross utes. I would say that if I remember correctly, last month the shift was about 400 basis points. And at these levels in fuel prices, our thought is it's probably going to be at this kind of range. Now, the low fuel prices is allowing additional, discretionary income in consumers' pocketbooks. However, we're not of the opinion that the low fuel prices actually drives an incremental unit of sales. It probably helps out mix, helps out on maybe option packages that a consumer may have not purchased, for example. But our worry and our concern is will there be an inflection point on fuel prices where they go back up? If it goes back to $80 or $100 a barrel, what will that do to the overall industry? And in that situation, obviously, if low fuel prices, you see a shift to trucks, high fuel prices, maybe you see a shift back to cars. But, again, CUVs, the smaller CUVs are fuel efficient. And I think that's where a lot of the manufacturers are focusing their attention. But again, we don't think it drives incremental unit sales, but it does help the mix.
Right, right. Mark, what do you guys think at Dealer Track there? Or do you have any opinions around fuel prices?
So I'd express my own opinion. I think consumers love their trucks and SUVs, and they're certainly red hot this year. And there's a large emotional component to the purchase decision. But I do think as fuel prices continue to rise, that economics will play more of a role in the purchase decision. So I do think that, it's a mix issue, as David said. So I think, eventually sedans and higher mileage, gas mileage, or fuel-efficient cars will rebound at some point in correlation with the increase in fuel prices.
Right. Tom, do you want to hop in there with any opinion?
Well, I agree with what Mark just said about the love affair we have with larger vehicles. Americans are getting larger, and so are their vehicles, it seems. And people seem to enjoy sitting higher, having the versatility of an SUV in terms of off-road capability, in terms of towing, hauling, passenger, accommodations, things like that. And winter conditions too play a role. So I think once people have gotten used to vehicles like that, sedans might seem a little limiting. So I think that is playing. Consumer tastes are playing a role in this. They don't often get as much airplay as gasoline prices do, and certainly gasoline prices play a role as well. So I would say there's, as those gasoline prices do get higher, which I believe they will, as but still not to the levels that we were seeing when there was an exit from the SUV class. And then the SUVs are more fuel efficient than they used to be, and people, I don't know if you know what an SUV is anymore, because there's crossovers that are maybe smaller overall, but still are classified as kind of an SUV type vehicle that get pretty good fuel efficiency as well. So with all that said, I think the health of that model class, if you want to categorize it as one major model class called SUVs, and I know there's a lot of sub-classes within that. I think the health of that segment is good.
Right.
Even in a rising gas price environment, provided those gas prices don't go through the roof.
Guys, we've seen some higher incentives and dollars on the hood. Also, apparently there seems to be increases in consumer cash. Do we expect to see that continue for the remainder of the year? David, what do you think here? What's your observations?
Oh, absolutely.
I was going to say, and what effect does that have on the residuals?
Oh,
you know?
Yeah, absolutely. I think over the next couple months, we could anticipate a higher level of incentives. It's difficult to say what's going to happen in Q4, and the main reason is that there's just too much inventory. The dealers that I speak with and I spoke to in the past have all said they're over-inventoried, they're pushing back on orders, and the day supply number that is out there from an industry standpoint, it's a little bit misleading because if you want a true inventory day supply, you got to really strip out fleet sales, and then you get a better idea of what's really out there. And when you do that, the numbers are obviously bigger than what the headline numbers are from a day supply basis. So the OEMs have, as we've been saying, really have two options or a combination of two: increase incentives and cut production. I mean, they could do either of the two, but I think a combination is probably more likely. And with any kind of increase incentives, it hurts the residual value. I mean, because essentially it's a repricing of the vehicle, and the markets are really good at taking that into consideration. So, I mean, all the audience knows if you have a $30,000 vehicle, and I'm going to use an extreme example here, but the OEM puts a $15,000 incentive. At the end of the day, when the guy walking out the door or gal just paid $15,000 on a $30,000 car, everybody's going to know that, and they're going to price the residual accordingly.
Right. Hey, Tom, are you seeing downward wholesale pricing pressure as a result as well through the lanes?
Yeah, as David just said, I mean, the transaction price of a new car basically represents the ceiling on a used car value. A used car value won't go for more than a transaction price of a new car, except on very, very, very rare occasions. So if you lower the ceiling, you're going to lower the used car value. So it's as simple as that. Right.
Guys, interest rates, there's been a lot of chatter in the news here. Just, boy, every day it seems like on interest rates. They're still at historic lows. Do we anticipate any rate increases this year? And that's especially taking into consideration the poor jobs number report for May. And Mark, I'll pass that over to you first.
Thanks, Dan. So I think that, I really don't see any material increases this year. The Fed didn't increase the rates last week when they met. And so I think that with the May jobs number, hopefully it's just an outlier, but I certainly don't see any increases in Q3 and perhaps even Q4. I mean, rates are at historic lows, and even with a small increase, they still will be at historic lows. David,
do you have any opinion there around
the I think sometimes it changes like the wind. So, like sometimes when you get great economic data and things seem to be rolling, then everybody goes on the bandwagon. Yeah, they're probably going to raise rates, and then we get some negative economic news, and then the probability of a rate raise goes down. So, I mean, at the end of the day, I mean, I want to say that the Fed is going to take into consideration all the data that's out there and do what's necessary from a fiscal management standpoint. But I have to say it's difficult to say. I mean, whether they raise or not, but like we mentioned on this morning's conference call, they do raise, whether it be probably 25 basis points, but does that really impact the consumer? And when you take a step back, I have a hard time thinking that it would, but I think it has more of a headline kind of an effect than rather than a true practical application kind of effect.
Right. Tom, do you have an opinion around the where we stand with interest rates?
I mean, I think it's been well discussed so far, and I would just add that the inflationary role, that the Fed plays in trying to make sure that there's it controls the inflation rate as best it can. I'd say that is still an area that I think has Janet Yellen considering the possibility of rate increases. So I'm still holding out for the possibility of 1 or 2 quarter-point increases this year on the basis of any signs of inflation that start to kick up. And some of the information out there, and again, it's early to tell still, I'd say. And when you look at the offsetting factor of jobs, or the role the jobs play in causing the Fed to delay any such increases, you got to weigh that in there too. So net, I think both sides need to be considered. We'll see if it's a one-time low jobs number, or if that's indicative of a trend. If it's indicative of a trend, you can expect the Fed to hold rates for a longer period of time. If the jobs start kicking back up again and continued signs of inflation are out there, then I think the Fed will make some modest increases in the tune of 1 or 2 increases for the year at a quarter point.
And then, guys, finally, we're running out of time here a little bit. Let's finish up with our last question. With us nearing a full political season, do you expect consumer confidence to remain strong? And David, I'll throw that one at you first.
Yeah, that's a very challenging question. I think the American public is very in tune to the economic headlines, and I think in general that's going to dictate their buying patterns, whether the headlines are domestic or international. So I think that's going to definitely play some level of factor, and you can never discount the election year factor, who's going to be in the White House next year, whether a Democrat or a Republican, and what's the trend going to be. But at the end of the day, I think as some of the other panel members have said, it's going to come down to employment, and if those numbers are good, there's going to be a sense of confidence going forward.
Right. Mark, do you have an opinion on this one?
I sure do. So I expect that, consumer confidence to remain strong for the remainder of the year. I think I have one caveat to that, and that would be depending on how the vote around Britain goes on Thursday. If they vote to exit the European Union, and that causes the U.S. stock market to really correct, I think that'll shake up consumer confidence a bit. But again, I'm not sure, the stock market is a leading indicator. I'm not sure that it has a dramatic effect on car sales levels for the remainder of 2016.
Yeah. Tom, do you have any comment on this? I think you might have touched upon it a little bit earlier.
Yeah, I did a little bit. I think it all kind of goes back to jobs again, but at the same time, economic fundamentals, I think, we had a very modest increase in the first quarter of 0.8% GDP growth. You need a little bit more than that to really get people confident in the economy, and I guess preliminary expectations for the second quarter and the remainder of the year, people are still expecting somewhere in the 2% range. That's still not great, but I think it's solid enough to hold consumer confidence at a level that will will be supportive of new and used vehicle sales.
Right. Well, listen, guys, I want to thank all of you for joining us today. This was an outstanding conversation. I know you guys are busy. You got a lot on your plate. And Mark, David, and Tom, thank you very, very much. We really appreciate your time. Please join us in July for another AutoTalk on cybersecurity. That'll be hosted by Wells Fargo. They'll be talking about emerging threats, best practices, how to safeguard data, and how to basically protect your company reputation. A lot of articles. There was a lot today in the news just about this very issue. So that'll be July 19th. We'll have one at 10 a.m. and repeat it again at 4 p.m. That's Eastern Standard Time. We're really excited as we enter into the election season to be doing a special election season series. Watch very carefully for some future announcements on that. That'll be our September, October, and November programming. The November programming, of course, will be basically a wrap-up of the elections and basically what that could mean moving forward. So watch for some special announcements and further details around that programming. Again, thank you very much. We appreciate your time, and we'll see you back July 19th.